Okay, welcome back. We are going to work through receivables now. So we just finished up a cash and primarily worked on the cash reconciliation. Now we're going to define receivables and understand the accounting issues related to their recognition. So receivables broadly are claims held against customers and others for money, goods, or services. These are oral promises of the purchaser to pay for goods and services sold, or written promises to pay for the sum of money on a specific future date. Most of these are oral commitments in terms of accounts receivable, but they can be both. We can have notes receivable or we can have accounts receivable. That is receivables, broadly speaking. They are claims against customers and others for money, goods, or services. That's receivables. That's our definition. So we have accounts receivable and notes receivable. The main difference there is whether it's an oral or a written promise to pay. Most receivables that companies record are what we would call trade receivables. They are receivables to their customers. And they represent generally oral commitments by their customers to pay for the goods that they've ordered. Now, it's an oral commitment, but the company has often and typically does a lot of credit background check to make sure that when the customer is paying in the future, that they actually think they will get paid. So this is not just an unsecured, we give money to whoever we want. There is background information here the company does do. But those are trade receivables. Those are receivables that the company has in response to its ongoing trade or business. So it sells to customers. The customer has an accounts receivable. The customer then pays the accounts receivable, and that's how the process works. Most of your basic accounting, your principles of accounting classes, most of your transactions worked under this idea that there were accounts receivable out there. That's trade receivables. There's also non-trade receivables that companies can have. Non-trade receivables are receivables to basically not trade. They're everything else. Now, there's really no restriction as to what these receivables may be. They could be advances to officers' employees. They could be deposits. They could be guaranteed future payment or for future performance, dividends, interest receivable, claims against insurance companies, any number of things that would generate, as we said what the definition was, some claim that the company has or some oral commitment the company has to receive payment. That would be a receivable. If it's not in the normal course of their trade or business, it's a non-trade receivable. Typically, these are split out where companies will report trade receivables and non-trade or other receivables. So that's broadly, that's what receivables are. So accounts receivable typically arise as part of a revenue arrangement, i.e. in the normal trade or operations of the business. That's an accounts receivable. So in order for, when we talk about an accounts receivable, the recognition of the account receivable, well, we're really dealing with the recognition of revenue or revenue recognition principles. Now, this revenue recognition is well beyond the scope of this course. Revenue recognition is a massive accounting area. There's a lot of difficulty in revenue recognition. We're not going to get into that. All my goal here, I will just present to you and walk through some of the things or some of the considerations that go into determining whether the revenue or whether the receivable should get recognized. I.e., we recognize the revenue, and if we recognize the revenue, we also then will recognize the receivable. So let's take a quick example. Let's say a company, Lululemon sells a yoga outfit for $100 on account. The yoga outfit is transferred and the customer obtains control of the outfit. When this change of control occurs, Lululemon should recognize an accounts receivable and sales revenue. They make the following entry. So they record accounts receivable for $100 because they sold this outfit for $100. They get to recognize the revenue. They record an accounts receivable, which is a debit for $100. And they record the sales revenue, which is a credit for $100. That's our accounting entry. Now, some things or indicators that we're going to take into account when we're determining that this account gets to actually be recognized, or we get to record the account receivable. Here's some indicators. So, one, the company has the right to payment from the customer. Right? they have the right to receive payment. Well, that's an indicator that their revenue has actually occurred. They have passed legal title of the good to the customer. So the customer now has possession and legal title to the good. The company no longer has any claims on that. If the customer wanted to go out and burn it, they could. It's theirs. The company no longer has claims on that. The customer has full legal title. They have transferred physical possession. Now, in this case, physical possession and legal title largely went hand in hand. They aren't separated in some way. It's not like they rented them the yoga outfit. That's kind of bad. Anyway, so they didn't rent them the yoga outfit. But physical possession shifting is one thing we can look at in terms of determining whether we should recognize the accounts receivable and the revenue. The company no longer has significant risks and rewards of ownership. As I mentioned, if the customer went out and burned it or wrecked on their bike and tore it to shreds, the company doesn't, I won't say they don't care, because that would be just bad, but they aren't going to experience any loss if the customer wrecks their bike and destroys their outfit. So the company no longer has a significant risk and rewards of the ownership of the good. And lastly, the customer has accepted the asset. The company can't just mail stuff to people and record revenue. The customer actually has to accept it. Usually that involves purchasing it to begin with. So there's our general process of roughly when, or some of the considerations that we take into account when we are looking at accounting to determine if we should recognize the accounts receivable and the revenue associated with that transaction. Now once we've figured out recognition, now we're going to measure it. So measurement of the transaction price. So the transaction price is the amount of consideration that a company expects to receive from a customer in exchange for the goods transferred or the services. That's the amount. It's the amount we expect to get. Now, sometimes that's very straightforward. When I go and let's say I bought something at Walmart and swiped my credit card, the amount Walmart is going to receive for that is pretty set. That is, they know the amount of consideration that they expect to receive. It's pretty structured. You can have variable consideration, which means maybe the amount I'm going to be paying is varied. Maybe it vary for any number of reasons. Maybe when I get it home, if I realize that part of it's broken, I'll return it. That's a possibility. In which case, was that a sale or was it not a sale? Also, if I pay quickly, they'll give me a discount. That's another option. Now, how should that be accounted for in terms of the measurement of the amount of the sale? Also, if let's say I'm buying a service and the company does a really good job, maybe they could earn a bonus. Like, let's say I want someone to come fix my roof, which I had to have done last month. And they say, hey, we can get it done in a day, or we can get it done today before you go on vacation, but it'll cost you an extra $200. Maybe that's worth it to me to have it done today as opposed to next week or whenever they want to show up. Or maybe I want them to do it when I'm on vacation so I don't have to sit in my house running remote classes with people pounding on the roof. Anyway, there's performance bonuses. Those performance bonuses also change the amount of the consideration. So we've talked about when do we recognize the account receivable or the revenue, and now we're talking about the amount that we get to recognize. And that, as we just talked about, that can change based on some events that at the time that the service is provided or that happen in the future. For instance, something breaks or there's a rebate or a possible discount for quick payment, right? Those things change the amount of consideration. So if we move on, if we talked about discounts, so looking at discounts, there's two types of discounts. One is what we call a trade discount. This is just a reduction from the list price. Trade discounts are nothing more than a company who has a list price and then what customers actually have to pay. You could call it like the sticker price. A trade discount is just saying like, oh, well, you don't have to pay the list price or the sticker price. You get this different price. Say it's 10% off of whatever the list price is. A lot of times what companies will do, especially when they're dealing with businesses, for instance, is they'll have a catalog with list prices for everything. And those list prices are always exorbitant. And then depending on who their customer is, they'll negotiate discounts from the list price. So if it's a big customer who's going to place lots of orders and be very valuable customer to have, maybe they'll give them a bigger discount because they know they're going to get a ton of orders. Maybe if it's a smaller customer, they'll give like a 10 or a 5% discount off of the list price. Those are called trade discounts. We ignore trade discounts from an accounting standpoint. The sale, the amount of the sale, is the amount that the customer will ever plan on paying. That's what we record. We don't record the sticker price. So we'll use the car example, not because, well, we'll use the car example because all of you can probably picture going and buying a car and the difference between the sticker price and what you actually walk out the door paying, right? The auto dealer does not get to record revenue for the sticker price of the car. They record revenue for what you actually paid for the car. So from that standpoint, accounting ignores the sticker price. So trade discounts are just the reduction from the sticker price. Accounting ignores those. We just pretend like they don't even exist. Now, that's trade discounts. There can also be what we call sales discounts or cash discounts. These are discounts that are based on some future payment. For instance, the most common is some way of incentivizing a cash payment. Maybe that's on a retail basis. Maybe that's an incentive to pay cash now. But more typically, it's like, well, if you pay in the next 10 days, we'll give you a 2% discount. We're just trying to encourage payment. Those are what you see terms of like 210 net 30, which is basically we get a 2% discount if you pay in 10 days, but the net is due in 30 days. That would be kind of typical payment terms. Now, cash discounts can be treated one of two ways. You can either do a gross method or a net method. The thing is, at the time of the sale, you aren't really sure which one your customer is going to take. So accounting basically says you can do it either way, depending on the circumstances. In practicality, that means that companies who have customers who usually take the discount are going to use the net method, and companies who have customers who don't usually take the discount are going to use the gross method. So the difference here, under the gross method, if let's say we make a sale for $10,000 with a 210 net 30 terms, which means the gross amount of the sale is $10,000. If they pay within 10 days, it's only $9,800. There's a 2% discount for paying within 10 days. So if we did the gross method at the time of sale, we're going to record accounts receivable and sales revenue for $10,000. And then if they pay within the 10-day period so that they get a discount, we're going to record the receipt of the cash, which will be less than the $10,000. And then we record accounts receivable for the total amount of the receivable. And we record a sales discount, which is the difference between the accounts receivable balance of $10,000 and the cash received balance. Now, that's if they pay within the discount period. Under the gross method, we have to record a sales discount at that point in time. Now, under the gross method, if they don't pay until the 30-day mark, then we just record the total amount. The $10,000 sale, we record they pay us $10,000 of cash. There's a debit to cash, credit to accounts receivable. For $10,000, we go home happy. So under the gross method, we're assuming that they're not going to pay within the discount period. And if they do, we record the difference between the receivable booked and the cash received as a sales discount. And the sales discount will have a debit balance because it is actually a contra sales account. It'll reduce the amount of sales revenue that we report on the income statement. That's under the gross method. Under the net method, we start out by recording the net amount or net of the sales discount, which is net of the $200. So we record our accounts receivable and our sale at $9,800 at the time of sale. Now that's assuming they're going to get this 2% discount. Therefore, if they actually take the 2% discount and they pay within those 10 days, we just record whatever credit accounts receivable, debit cash for $9,800, and we're done. They took the discount. That's what we had projected when we recorded the sale. So we're done. Now, under the net method, if they don't pay within the discount period, we then have to record basically what would be kind of the overpayment based on what we record as receivables at the time of payment. So we get the full amount of cash. We relieve their accounts receivable for the full amount, but we first have to basically increase their accounts receivable for the discount that they didn't take to bring their accounts receivable up to the $10,000 or the gross amount, and then record what we call a sales discounts forfeited. Sales discounts forfeited is essentially an adjunct sales account. It increases the amount of sales for the period. So under the net method, if they don't pay within the 10-day period, in this situation, we have to increase sales through a sales discounts forfeited account to bring net sales up to gross because they didn't take the discount. That's under the net method. If we're using the gross method and they do pay within the discount period, we use a sales discount account to reduce the value of sales recorded to take into account that they actually took the sales discount when we were not expecting them to. So that's cash discounts and how they get recorded. Next, we're going to move on to something else that can change the amount of the receivable or the amount of the revenue for that matter, and that's sales returns and allowances. Sales returns and allowances is a contra revenue account to sales revenue. So we have sales revenue, but some of that revenue customers are going to actually return, or it's going to be broken or something. So that's actually a reduction in the amount of sales we make. And we record that as sales returns and allowances. It is typically tracked in its own account. And that's because management wants to know if they have a bunch of sales returns and allowances, they don't just want it baked into a lower sales number. So we have the sales returns and allowances. It is a contra revenue account to sales revenue. Allowance for sales returns and allowances is a contra asset account to accounts receivable. So the allowance for that is the receivable side. The sales returns and allowances is the revenue side. So there are two accounts. There's a sales returns and allowances, which is a contra revenue account, and there's an allowance for sales returns and allowances, which is a contra asset account to the accounts receivable. Remember, one way to remember it is allowances are typically balance sheet accounts. So the allowance for sales returns is an allowance to some asset. That is what, so it goes as an allowance to receivables. Here's the idea. If I make a sale on account, there's a chance that sale, let's say, will get returned. Well, I need to essentially estimate the amount of sales that I'm going to have returned, and that's going to reduce my revenue. It's simultaneously going to reduce my receivables because those are sales I have sitting in receivables that I'm not actually going to get cash for, so they shouldn't be recorded as a receivable. I estimate the allowance for those sales returns and allowances, and I reduce the receivable by that allowance. At the same time, I reduce the sales account for sales returns and allowances, making sure that works on both sides. The use of both the sales returns and allowances and the allowance for sales returns and allowances account is helpful in identifying problems. So with inferior goods, this is why management wants to track it separately and why we use separate accounts as opposed to let's just reduce the sales account, for instance. That would not provide as good of information. So let's assume that Max Glass sells $5,000 of hurricane glass to Oliver Builders on account. They estimate that $400 of this glass sales will be either returned or an allowance will be granted. So Max Glass records the sale on account and records the allowance for sales returns and allowances as follows. So we have accounts receivable of $5,000 because that's the amount of the sale that they made, and they record sales revenue of $5,000. There's where we start. Now, they're estimating $400 of this $5,000 will get returned or they'll give an allowance. So we're going to debit sales returns and allowances. Remember, this is a contra revenue account, so as a debit balance, we debit sales returns and allowances for $400. That's setting up the chance that these sales might not actually have been sales that end up going through. And then we also set up our allowance for sales returns and accounts, which is our contra asset account, which is a credit of $400 to that. That will reduce the amount of receivables for this same sale. Now, let's assume that Max Glass now grants an allowance of $400 to Oliver Builders because some of the hurricane glass is of lower quality than originally ordered. The entry to record this transaction is, first, we're going to debit the allowance for sales returns and allowances. So, at first, we estimated the amount of the allowance, and we recorded that as a reduction in sales and a reduction in the receivable. Now we actually know what it is. It's $400. We are going to record that $400, not that we're not going to get it. So we take the allowance away. The allowance we set up now goes away. But we simultaneously take the receivable away. So all we're doing is closing out the allowance to the receivable by saying, okay, now we know it's $400. We're going to take that receivable away. The customer, Oliver Builders, does not owe us that $400. We're going to take the $400 out of their receivable. And we're also, the other side of that transaction is going to be the allowance for sales returns and allowances, because that was a general estimate, not specifically applied to the goods. And sometimes it's not even applied to the customers. Practically speaking, most companies at the end of a quarter, that's when they estimate their allowances. So their allowance for sales returns and allowances and their sales returns and allowance account, that gets estimated at the end of every period when they record their financial statements. So that's how this gets recorded. Now, that is how we handle adjustments due to sales returns and allowances. Now, this brings up a good point. We just had a whole chapter on time value of money, and receivables, by definition, are not collected now. That's why they're sitting in receivable. And we have yet to talk at all about interest rates or time value of money or discounting future cash flows or any of this stuff that we just learned in the last chapter. So that's a great point. So theoretically, any revenue after the period of sale is interest revenue, right? Well, yes, theoretically. However, companies ignore interest revenue related to accounts receivable because the amount of the discount is usually not material in relation to net income for the period. It's just not material. It's a lot of work for something that's not material. And the profession has, because of this, the profession has specifically excluded from present value considerations receivable arising from transactions with customers in the normal course of business, which are due to customary trade terms and don't exceed 1 year. So basically, if you're selling stuff with less than a 1 year receivable, which most people are, then you don't have to take into account the time value of money for the receivable. You just book it at what you expect to receive. Everyone knows that, and fortunately, we're not in an environment, at least in our country right now, where the interest over a 3-month period even is suddenly going to be material for a company and change their net income in any material way at all. So that's how we handle time value of money. Now, doubtful accounts. So for allowance for doubtful accounts, I'll be covering that when we talk about the valuation of accounts receivable in the next segment. Right now, we're just going to take a quick break.